Guys, welcome back to my channel, Subsistence Traveling. I'm your host, Jay. Today I'm going to be talking about the market sell-off. Um, the S&P 500 was down today, 3.03%, and that's following another sell-off yesterday of around 3%. Okay, so we're gonna go ahead and talk about this sell-off. Okay. All right, so real quickly, these are the update, just an update on the coronavirus. 80,996 cases, 2,763 deaths, and 30,050 recoveries. Now, this sell-off is said to be the cause of the market sell-off over the past few days. Now, to tell you the truth, I don't believe that the outbreak is the cause of the sell-off. But however, I'm going to go ahead and tell you how you can protect yourself during the sell-off. Okay. All right. So first, we're gonna speak about the dividend-paying stocks. Okay. Now, my advice with the dividend-paying stocks, I would tell you to pick individual stocks. I would stay away from in this environment. I would stay away from ETFs or index funds in this environment. This environment will be a better environment for stock pickers. Okay, and that way you have the ability to beat the market. Okay, I would prefer that you choose foreign stocks because I think this is what's going on. I think this is a rotation in outside of the U.S. So I believe it would be best to pick foreign stocks because they have better yields overseas, anyways. Okay, so that's the main reason why you would pick foreign stocks. Another thing I would say, go with real assets, your materials, industrials, energy, banks, REITs. If it's something you could eat, drink, I think you should stay with the real assets. Okay? Um, Dividends are very important when you're dealing with a downturn because without interest or dividends, you're purely speculating. And the right now the yield on the S&P 500 I think is around 1.8%, and the yield on the 10-year treasury I think is 1.35%. So as the yields go lower, you're taking more risk for less reward. Okay, so that's the importance of dividend paying stocks. Okay. All right, and as you see, this is a picture of the different sectors and the performances. Today, they say consumer staples did very, I guess, perform best, only down 1.75%. And then utilities only down 2.16%. So, just some information there. Okay, so the next thing to assist you in a downturn are preferred stocks or preferred shares. Okay, now just a little bit of information. Preferred stocks survived the crash of 1929. Okay, now with preferred stocks, you get consistent yields. Okay, they pay good dividends, and the main reason they usually survive a downturn, they're higher on the capital structure than common shares. So on the top of that structure, you have secured debt, unsecured debt, preferred shares, and then common shares. When a company goes bankrupt, by the time when you sell the assets off, by the time you get to the common shares, there's no money left over. Okay, so preferred stocks, it's a possibility that there may be money left, to pay the preferred shareholders. Now you can buy preferred stocks. You have ETFs, or you can buy them individually through your brokerage account. Depending on, you have to check with your broker. A few ETFs is IPFF, ticker symbol IPFF. I'm sorry, IPFF is the international preferred stocks. That's iShares. Then you have PGX, which is Invesco US preferreds. And then PFXF, that's Vanek Vectors US preferred X financials. Okay. Okay, so those are some ticker symbols you can research. Okay. Now, this is just a quote from Bloomberg for the IPFF, iShares International Preferred Stock ETF. Today, this ETF was only down 0.13% compared to the 3.03% for the S&P 500. So clearly, you would have lost way less money in this ETF. Okay. All right. So now we're gonna go to fixed income. Okay. And when it comes to fixed income, your best bet in this environment is diversification. You want to be diversified throughout fixed income. When I say fixed income, you don't want to just own treasuries. Okay, you want to own treasuries, corporates, municipals, emerging markets, short term. You want to be diversification is the main thing with in this environment, because it's a possibility that interest rates may rise. So you want to be very diversified in your fixed income portfolio. You want to consider ultra short term debt. And this is another thing. We're in a very iffy situation with interest rates right now. They may go up. They may continue to go down. So ultra short term is your best bet in this environment, because if interest rates were to go up, you're not going to lose as much with ultra short term. Okay, you want to consider emerging markets, okay, because they have better yields in the emerging markets, okay, and you want to chase yield, okay. It's a matter of risk and reward. You want to take risk, but you want to also hedge your bets, okay? So that's why, diversification is your best bet, okay? You want to take some risk, but you also want to hedge those bets as well. So you want to be diversified with your fixed income. All right? So the next thing on the agenda is alternatives. You want to consider alternatives in this environment. Okay? Now, top of the list is precious metals. Okay? Now, you can either hold precious metals physically, or you can there are plenty of ETFs or funds that own. Obviously, it's better to hold them physically, but you can pick whether you like physical or ETF. You want to consider the currency markets, okay? And you can access the currency markets with ETFs now, or you can do it the traditional way by trading currency. The thing with the currency markets, it's less volatile than the stock market. It's the movements in the currency markets. Even if it goes down, it's less volatile than the stock market. If you were in the currency markets, you wouldn't have lost as much as you lost today in the markets. You want to consider the futures market as well. Okay, and you can access the futures markets via ETF, or if you have money like that, you can straight up just buy futures. Okay, the futures market, there's not as much liquidity in the futures market. So there's a possibility that in this downturn, the futures, a lot of times managed futures perform very well in downturns. Okay, so that's an alternative to consider. You want to also consider options, and options, I guess, if you're more of a trader, because the options thing is very complicated. You can consider either options or inverse ETFs, that will help you to protect yourself in a sell-off. And you want to consider alternatives. Diversification is key in an environment like this. Okay, so don't neglect alternatives. Okay. All right, so I'm just gonna show you. This is just a quote of the ProShares short S&P 500, ticker symbol SH. Basically, this ETF, it shorts the S&P 500. Now, if you held this ETF today, you would be up 2.96%. Okay, so all right, this right here is the currency shares Canadian Dollar Trust. Now, if you were in this ETF today, you would have been up 0.02%. Okay. And this is the ProShares Managed Future Strategy ETF. This is an actively managed ETF. And it was the price for this was unchanged for the day. Okay, so basically you wouldn't have lost any money if you were invested in this ETF. Okay, so that's one of the reasons why alternatives, you want to consider alternatives. Last but not least, the most important thing you want to do in this environment is raise cash. Okay, when I say to raise cash, you want to diversify your cash. Okay, you want to have some in the bank. You know, we're in a civilized society now, so I guess most of us keep our money in the bank. You want some in the bank, but you also want to have some at home, some physical cash as well. I think we're coming up into a period of maybe entering into negative interest rates, and banks are going to come with some very expensive fees. So you want to consider holding cash at home. You want to consider some ultra short term debt instruments, ultra short term bonds, short term treasuries. It'd be a good way to hold cash. The Fed will always print money to buy treasuries. So that's one thing you want to consider. There are situations where treasuries are can sometimes be even safer than the cash in your bank account. You also want to consider money market instruments in this environment, whether it be money market mutual funds, money market ETFs, CDs, different instruments, available. Okay, so my final thoughts, all right? My final thoughts is for everyone to evaluate risk and reward. Okay? Again, a 10-year treasury paying 1.35% is not worth the risk. The S&P 500 yielded 1.8% is not worth the risk. When there are markets, for instance, Canada is yielding close to 3%. Russia is yielding, I think, close to 5 or 6%. Singapore yielding between 3 and 4%. A lot of emerging markets. You want to evaluate risk or reward because, like I said to you earlier, if you're not getting interest or dividends, then you're purely speculating, and you're not an investor. You're speculating. So you don't want to, if you're a speculator, fine. But again, evaluate risk and reward. Okay, my next thing is consider international and emerging markets. Okay, because again, that is where the yield is. If in my opinion, I think you should chase yield in this environment because taking risk with no reward, again, it's just you're gonna lose in the end. Okay, so my last point is traditional safe havens may not be so safe. Okay, and that's one of the reasons why I brought up alternatives. When most people will tell you that alternatives are dangerous and you'll lose money. In this environment, diversification is key, and especially in this environment, I believe the U.S. dollar is gonna go down from here. Matter of fact, the dollar was down. Usually in sell-offs, the dollar goes up. The dollar was down today. The Canadian dollar, the pound, and the euro was up today. So again, diversification is key. The worst thing is when everyone pile into an asset thinking it's safe. And I think in this environment, I think money is going to leave the US and it's going to go outside of the US. So again, traditional safe havens may not be so safe, so diversification is key. All right, so I'm gonna just leave. Basically, we're looking at these Asian markets, and the Asian markets, you know it's so funny because most of the coronavirus cases are in Asia, but Asian markets held up much better than the rest of the world. That's very interesting. Okay, so again, guys, diversification is key. Again, I hope I was able to share some useful information with you. I hope you like, share, and subscribe. Again, peace to all.